Stop. Before you buy another stock, before you check your portfolio, before you make another investment decision, you need to know something. 95% of investors commit the same 7 psychological sins over and over. These sins have destroyed more wealth than every market crash in history combined. I'm Charlie Munger. I'm 99. I watch brilliant people much smarter than you, completely destroy themselves financially because they couldn't stop committing these sins. So in this video, I'm going to break down each of the 7 deadly sins of investing. I'm going to show you exactly how they destroy wealth. I'm going to give you real examples, some from my own mistakes, some from other investors I watched fail. And most importantly, I'm going to give you the specific systems I use to avoid these sins. This is wisdom that took me 60 years and tens of millions of dollars in losses to learn. Pay attention. Let's start with the first deadly sin. The first deadly sin of investing is envy. And I'm going to tell you something that's going to surprise you. Envy is probably the stupidest of all the 7 sins. And it's the one that nobody talks about. Here's why envy is so destructive in investing. When you look at what other people are making, your neighbor who made a killing in Bitcoin, your brother-in-law who's up 300% on some tech stock, the hedge fund guy bragging about his returns at a cocktail party, your brain does something very dangerous. It starts making decisions based on relative performance instead of absolute returns. Let me give you a concrete example. Suppose you make 20% on your investments in a year. That's excellent. That beats the market. That beats most professional investors. But then you find out your cousin made 50% on some speculative stock. Suddenly your 20% feels terrible. You feel like a fool. You feel like you're missing out. So what do? You chase performance. You take more risk. You invest in things you don't understand, and you destroy your wealth. This is envy in action, and it's catastrophically stupid. Because here's the reality. There will always be somebody, somewhere, making more money than you on some investment. Always. If you let that drive your decisions, you're finished. You'll spend your life chasing returns you don't understand in areas where you have no competence. Now you might think, Charlie, envy isn't that big a deal in investing. But you're wrong. Let me tell you how deep this goes. When I look at the investment disasters I've seen over 60 years, long-term capital management, the dot-com bubble, the housing bubble, countless individual investors wiping themselves out, envy is there at the root of almost every one. Take the tech bubble of the late 1990s. Why did intelligent, educated people invest their life savings in companies with no revenue, no profits, and no viable business model? Because their neighbors were getting rich doing it. Because they saw 23-year-olds becoming millionaires overnight. Because CNBC was showing charts of stocks going up tenfold in 6 months. It was pure envy. Fear of missing out, and it destroyed billions of dollars of wealth. Warren and I sat out that entire bubble. People mocked us. The press called us out-of-touch old men who didn't understand the new economy. Our shareholders complained that we weren't participating in the boom. But we weren't envious. We looked at the valuations, saw they made no sense, and did nothing. Just sat on our cash and waited. That took discipline. But more importantly, it required completely eliminating envy from our decision-making process. We didn't care that other people were making money. We didn't care that we looked foolish. We only cared about whether the investments made sense at the prices available. That's it. So how do you avoid the sin of envy? Let me give you the specific mental model I use. I never compare my returns to other people's returns. Never. I compare my returns to my own expectations and to the returns I could get in alternative investments. That's the only relevant comparison. If I can make 15% annually with low risk in something I understand, and my alternative is making possibly 30% in something I don't understand with high risk, I take the 15% every single time. I don't care if my neighbor makes 40% on some crypto trade. Good for him. Doesn't affect my decision at all. Here's another technique. I deliberately avoid knowing what returns other people are making. I don't ask, I don't look, I don't participate in conversations about who made what on what investment. Why? Because that information is toxic. It serves no useful purpose and only triggers envy. Warren has a great line about this. He says, "It's not greed that drives the world, but envy." He's right. Greed you can sometimes use productively, but envy is pure poison. It makes you do stupid things. It makes you take risks you shouldn't take. It makes you invest in things you shouldn't invest in. It destroys compound interest by causing you to trade too much and chase performance. Let me tell you about the actual psychological mechanism here, because this is important. Envy triggers what psychologists call social comparison. Humans are hardwired to evaluate themselves relative to their peer group. This made sense in our evolutionary past. If everyone in your tribe had more food than you needed to do something about it or you'd starve. But in investing, social comparison is catastrophic. Your return should be evaluated based on risk-adjusted performance relative to available alternatives, not relative to what some random person made on some random investment. But your brain doesn't naturally think that way. It thinks, he made more than me, I'm losing. I need to change what I'm doing. That instinct will destroy you, so you need to systematically override it. You need rules and systems that prevent envy from affecting your decisions. Here's my personal system. I have written investment criteria. I only invest in opportunities that meet all my criteria. I don't care what anyone else is doing. I don't care what's hot. I don't care what's working for other people. I stick to my process, period. This sounds simple, but it's psychologically very difficult, especially during bubbles, when everyone around you is getting rich and you're sitting on the sidelines. Your brain is screaming at you to do something. Social proof is kicking in. Authority figures are telling you the rules have changed. Everyone seems smarter than you because they're making more money. That's when you need discipline. That's when you need to remember that envy has destroyed more investors than any other factor. And that's when you need to have the character to sit on your hands and do nothing. Here's the bottom line on envy. It's a sin, not just because it feels bad, though it does. It's a sin because it causes you to make decisions based on irrelevant information. Other people's returns have nothing to do with whether a particular investment is good for you. Nothing. But envy makes you think they do. And that's how it destroys wealth. I've seen brilliant people, PhDs, successful business people much smarter than me, completely destroy themselves financially because they couldn't handle watching other people get rich. They kept reaching for more return, kept taking more risk, kept chasing performance, and eventually they blew up. Don't be that person. Eliminate envy from your investing process. Compare yourself only to yourself. Measure your returns against your plan, your risk tolerance, your alternatives. Never against what your neighbor or your brother-in-law or some hedge fund is doing. Do that and you'll avoid the first deadly sin. But envy is just the beginning. The second sin is even more destructive, and most investors don't even know they're committing it. Now we get to the second deadly sin of investing, overconfidence. And this one is particularly insidious because the smarter you are, the more susceptible you become to it. I've seen more money destroyed by overconfidence than by almost anything else. Here's what overconfidence looks like in investing. You make a few successful investments. Maybe you pick a stock that doubles. Maybe you call a market top. Maybe you correctly predict some economic trend. And your brain says, I'm good at this. I understand how markets work. I can see things other people can't see. That's the beginning of the end. Because what's actually happening is that you're confusing luck with skill. You're taking a small sample size, a few successful trades, and drawing conclusions about your ability that aren't justified. You're committing what statisticians call overfitting your results. Let me give you a personal example of how this destroyed me early in my career. Back in the 1960s, I had a series of very successful investments. My partnership was compounding at over 25% annually. I was crushing the market. And I started to think I was a genius. I started to believe I could figure out any investment, analyze any business, predict any trend. So I made an investment in a trading stamp company, blue chip stamps. It was bigger and more concentrated than I should have made. Now it turned out okay in the end, but I got lucky. I was overconfident about my ability to analyze the business and predict the outcome. If things had gone slightly differently, I could have lost everything. That experience taught me something crucial. My early success was partly skill, yes, but it was also partly luck. I happened to invest during a period that favored my style. I happened to find opportunities that fit my strengths. I happened to avoid several pitfalls that could have destroyed me. And I started to confuse all of that luck with pure skill. This is what overconfidence does. It makes you think your success was inevitable. It makes you think you have abilities you don't actually have. And then it makes you take risks you shouldn't take because you don't properly assess the downside. Now let me tell you what makes overconfidence particularly dangerous. It's not just about individual investments. It's about your entire approach to risk management. When you're overconfident, you don't prepare for things going wrong. You don't build in margins of safety. You don't question your assumptions. You just plow ahead convinced you're right. I saw this destroy long-term capital management in 1998. Here you had some of the smartest people in finance, Nobel Prize winners, former Fed vice chairman, PhDs in mathematics and economics. They built incredibly sophisticated models. They were absolutely convinced they understood risk better than anyone else in the world, and they were overconfident. Their models didn't account for extreme events. Their models assumed markets would behave rationally. Their models used historical correlations that broke down under stress. But they didn't question their models because they were overconfident in their own brilliance. So when things went wrong, when Russia defaulted, when markets became illiquid, when correlations changed, their models failed catastrophically. And because they were using enormous leverage, they didn't just lose money, they nearly crashed the entire financial system. That's what overconfidence does. Here's the psychological mechanism behind overconfidence. Your brain has a systematic bias toward overestimating your own abilities. This has been proven in hundreds of experiments. 90% of people think they're above average drivers. 80% of business owners think their business will succeed, even though 60% fail. Investors consistently overestimate their ability to beat the market, even though the statistics clearly show most can't. Why does the brain do this? Probably because throughout human evolution, confidence was rewarded. The confident person got the mate, led the tribe, took the risks that sometimes paid off. So we're hardwired to be overconfident. But in modern investing, this hardwiring kills you. Because investing isn't like leading a tribe. In investing, your overconfidence doesn't inspire followers or intimidate rivals. It just causes you to miscalculate probabilities, underestimate risks, and make stupid decisions. So how do you fight overconfidence? This is tricky because you can't just tell yourself, don't be overconfident. Your brain will ignore that. You need systems and processes that force humility on you, even when you don't feel humble. Here's what I do. First, I keep a written record of my investment predictions and decisions. Then I review them regularly to see how often I was right and how often I was wrong. This is brutally honest feedback that counteracts overconfidence. When I look at my actual track record, not my memory of my track record, but the actual written record, I see that I'm wrong frequently. I see that many of my successful investments worked for reasons I didn't predict. I see that I've made plenty of mistakes. This keeps me humble. Second, I actively seek out people who disagree with me. This is hard because it's psychologically uncomfortable, but it's essential. If you surround yourself with yes men or people who think like you, your overconfidence grows unchecked. You need people who will challenge your assumptions and point out your blind spots. Warren is my sounding board for this. We disagree on things regularly, and when we disagree, I have to defend my position. I have to articulate my reasoning. I have to confront alternative viewpoints. This process reveals overconfidence. It forces me to question myself. Third, I use checklists. Before making any significant investment, I work through a written checklist of questions I need to answer. This prevents overconfidence from causing me to skip steps or overlook risks. The checklist doesn't care how confident I feel. It just makes sure I've done the work. Fourth, I practice inversion. Instead of just thinking about why an investment will work, I spend at least as much time thinking about why it will fail. I ask, what has to go right for this to succeed? What could go wrong? How likely is each scenario? What's my downside if I'm wrong? This inversion process counteracts overconfidence because it forces you to confront the bear case. It forces you to imagine failure. It makes you question your assumptions. Most investors only do the bull case. They convince themselves why something will work, then they invest, and then they're shocked when it doesn't work. I do both cases, always, and I don't invest unless I'm comfortable with the worst case scenario. This has saved me from countless disasters. Fifth, and this is perhaps most important, I maintain a large margin of safety in every investment. I never pay full price for anything, no matter how confident I am. I never use leverage that could destroy me if I'm wrong. I never bet everything on one outcome. Why? Because I know I'm frequently wrong. I know I'm overconfident. I know my analysis has gaps. So I design my approach to survive being wrong. If my thesis is correct, I make good money. If my thesis is wrong, I don't get killed. That's the goal. Let me give you a specific example of how this works. Suppose I think a stock is worth $100 and it's trading at $75. If I'm overconfident, I might think, this is obviously worth $100. I'll buy as much as I can. Maybe I'll even use leverage to buy more. But I'm not overconfident, or at least I have systems to combat my overconfidence. So instead I think, I believe it's worth $100, but I could be wrong. What if it's only worth $80? What if I've missed something? I'll buy some at $75, which gives me a margin of safety. But I won't bet everything on this one idea. That margin of safety, that acknowledgement that I could be wrong, is the antidote to overconfidence. It doesn't prevent me from investing. It just prevents me from betting so much that being wrong destroys me. Here's the bottom line on overconfidence. You are not as smart as you think you are. Your successful investments were partly luck. Your analysis has blind spots. Your predictions will frequently be wrong. Accept this. Design your investment approach around this reality. Build in margins of safety. Seek out disagreement. Question yourself constantly. Do that and you'll avoid the second deadly sin. But we're just getting started. The third sin is one that destroys even the most disciplined investors. The third deadly sin is greed. Now you might think greed is obvious. Everyone knows greed is bad, but you're wrong. The kind of greed that destroys investors isn't the cartoon villain rubbing his hands together plotting to steal money. It's much more subtle and much more common. Here's what greed looks like in real investing. You have a good investment that's worked well. It's up 50%. It's exceeded your expectations. Logically, you should probably take some profits, or at least rebalance. But greed whispers, why sell now? It could go up another 50%. Why settle for good when you could have great? Or maybe you found a great company at a fair price. It meets all your criteria. You should buy. But greed says, wait for a better price. If I'm patient, I might get it 10% cheaper. So you wait. And while you wait, the stock goes up 30%. And you miss it entirely because you were greedy for that extra 10%. Or here's the most common form of greed, the one that destroys more investors than anything else. You're doing well, making good returns, living comfortably, but it's not enough. You want more. You want it faster. So you start using leverage, or you start taking bigger risks, or you start investing in things outside your competence because they promise higher returns. This is greed, and it's the amplifier of all the other sins. Greed makes envy worse. You're not just envious of others' returns, you're desperate to match them. Greed makes overconfidence worse. You convince yourself you can handle more risk because you want the higher returns. Greed makes impatience worse, makes poor judgment worse, makes bad decisions worse. Let me tell you about the actual mechanism of how greed destroys wealth. It's not that greedy people lose money on every investment. In fact, greedy people often make spectacular returns for a while. They take big risks, they use leverage, they concentrate their bets, and sometimes they get lucky, they make huge money. But here's the problem. Greedy people eventually take one risk too many. They eventually use too much leverage. They eventually bet too much on one outcome. And when that happens, when luck turns against them, when markets become volatile, when something unexpected happens, they don't just lose their gains, they lose everything. One bad outcome wipes out decades of successful outcomes. This has happened over and over again throughout financial history. Jesse Livermore, one of the greatest traders who ever lived, made and lost several fortunes because of greed. He would make millions through brilliant trading. Then he would get greedy, use too much leverage, and blow up. This cycle repeated until he eventually died broke. Or look at Lehman Brothers. Smart people, sophisticated risk management, decades of success. But greed, the desire for higher returns, bigger bonuses, more market share, caused them to take on too much leverage and too much risk in subprime mortgages. When the market turned, they were wiped out in weeks. The difference between Berkshire Hathaway and Lehman Brothers isn't intelligence, it's greed. Warren and I were never greedy enough to use the kind of leverage that could destroy us. We were never greedy enough to reach for returns we didn't fully understand. We were content with good returns on a sustainable basis, rather than spectacular returns that depended on everything going right. This is a critical distinction. Greed makes you optimize for maximum returns. Wisdom makes you optimize for sustainable returns. Greed makes you ask, how much can I make? Wisdom makes you ask, what's the most I can make while ensuring I don't blow up? Now let me tell you how to fight greed. This is difficult because greed is deeply rooted in human nature. We evolved to want more. In our ancestral environment, more food, more resources, more status directly translated to survival and reproduction. so our brains are wired to always want more. But in modern investing, always wanting more will destroy you. So you need to rewire your thinking. You need to define enough. You need to know when to stop reaching for more returns and instead focus on protecting what you have. Here's my personal approach. I decided very early in my life what enough was for me. I didn't need to be the richest person in the world. I didn't need to maximize every possible dollar. I just needed to be financially independent and able to do what I wanted. Once I reached that level, additional money had diminishing marginal utility. This mindset, knowing what enough is, immunized me against greed, because once I had enough, I didn't need to take excessive risks. I didn't need to use leverage. I didn't need to reach for higher returns. I could focus on not losing money rather than making the absolute maximum. Another technique is to separate your needs from your wants. Your needs are finite. You need food, shelter, education for your children, health care, some level of comfort and security. You can calculate what those needs cost. Your wants are infinite. There's always a bigger house, a fancier car, a more expensive vacation. If you let wants drive your investment decisions, greed will destroy you. I also use a specific rule about leverage. I never, and I mean never, use so much leverage that a bad outcome could wipe me out. I always want to survive to play another day. This rule has saved me countless times because it prevents greed from pushing me into danger. Here's another key insight about greed. Greed makes you focus on the upside and ignore the downside. When you're greedy, you spend all your time imagining how much money you'll make if everything works out. You don't spend enough time thinking about what happens if things go wrong. So I force myself to spend at least as much time on the downside analysis as the upside analysis. Before I make any investment, I ask, if I'm wrong about this, how much can I lose? Can I afford to lose that amount? What would cause me to lose it? How likely is that scenario? This disciplined downside analysis counteracts greed, because when you really confront the downside, when you imagine losing your capital, missing payroll, having to sell at the worst possible time, greed loses its power. You become more cautious. You build in more margin of safety. Let me give you one more specific example of how to fight greed. When I make a successful investment and it appreciates significantly, my instinct, and everybody's instinct, is to hold it because maybe it'll go up more. That's greed talking. Instead, I force myself to ask, if I didn't own this investment today, would I buy it at the current price? If the answer is no, I should probably sell or at least reduce my position. This simple question counteracts greed because it makes you evaluate the investment objectively rather than through the lens of wanting more. The bottom line on greed is this. It's not about making the maximum amount of money. It's about making good money sustainably over long periods of time. Greed causes you to optimize for the wrong thing. It causes you to take risks that you might get away with for years, but that will eventually destroy you. Munger has a great line. To make money, you need to be fearful when others are greedy, and greedy when others are fearful. That's exactly right. Real investment success comes from controlling your greed when opportunities are scarce and unleashing your greed when opportunities are abundant. But most people do the opposite. They're conservative when markets are cheap and nobody wants to invest, and they're greedy when markets are expensive and everyone wants to invest. This is backwards, and it's driven by greed misapplied at the wrong times. Avoid greed. Define what's enough for you. Never use leverage that could destroy you. Focus as much on downside as upside. And remember, good returns, sustained over decades, beat spectacular returns that eventually blow up. Every single time. Now on to the fourth sin, and this one is probably the most common among otherwise intelligent investors. The fourth deadly sin of investing is impatience. And I'm going to tell you something that most people don't understand. Impatience is probably the most expensive sin of all when you calculate the opportunity cost over a lifetime. Here's why impatience is so destructive. Compound interest is the most powerful force in investing. Einstein allegedly called it the eighth wonder of the world. But compound interest requires time to work. It requires you to let your investments grow without interruption. And impatience is the enemy of time. When you're impatient, you trade too much. You sell winners too early because you want to lock in gains. You move from investment to investment looking for the next big thing. You interrupt the compounding process over and over again. And every time you interrupt compounding, you pay a price. Transaction costs, taxes, bad timing, and most importantly, lost opportunity. Let me give you a specific example. Suppose you invest in a great business that compounds at 15% annually. If you hold it for 40 years, you multiply your money by about 268 times. But if you sell after 10 years because you're impatient, make another investment that also compounds at 15%, but then sell that after 10 years, and repeat this 4 times, you still only multiply your money by about 16 times. Same annual return, same time period. But by interrupting the compounding, by being impatient and trading in and out, you end up with only 6% of the wealth you could have had. That's how expensive impatience is. Now you might say, Charlie, surely if you're finding new investments, you can do better than just holding one thing. And sometimes, yes. But here's what actually happens in the real world. When you're impatient and trading frequently, you make mistakes. You buy at the wrong time. You sell at the wrong time. You incur taxes. You pay fees. You act on impulse rather than careful analysis. Warren and I have held some positions for decades. See's Candies. We bought that in 1972 and still own it. Coca-Cola. Warren bought that in 1988 and still owns it. American Express. We've held that for over 50 years. These investments have compounded for us through multiple market cycles, multiple recessions, multiple crises, and the returns have been extraordinary. Why? Not because we're brilliant at picking investments, but because we're patient enough to let compound interest work. We're patient enough to do nothing when doing nothing is the right move. We're patient enough to hold through volatility, through pessimism, through periods when nothing seems to be happening. Most investors can't do this. They get bored. They see other opportunities. They worry they're missing out on something better. So they sell their winners and move on. And they destroy their compounding in the process. Let me tell you about the psychological mechanism behind impatience. Humans have what psychologists call a present bias. We overweight immediate rewards and underweight future rewards. This made sense in our evolutionary past when the future was uncertain and immediate gratification often meant survival. But in modern investing, present bias destroys wealth because the biggest rewards in investing come from patience. They come from holding great businesses for decades. They come from letting compound interest work its magic over long periods of time. Your brain doesn't naturally think this way. Your brain wants action. It wants immediate results. It wants the dopamine hit of selling something for a gain or buying something new. So you need to systematically override these instincts. Here's how I fight impatience. First, I make very few investment decisions. I'm not joking about this. In a typical year, I might make 2 or 3 significant investment decisions. That's it. The rest of the time I'm doing nothing, just reading, thinking, waiting. This is completely opposite to how most investors operate. Most investors feel like they need to be doing something constantly, buying, selling, rebalancing, adjusting. They confuse activity with progress, but activity is often the enemy of returns. I have a rule. If I don't have a compelling reason to act, I don't act. Inertia is my default. This forces me to be patient because doing nothing is the path of least resistance. Second, I think about investments in terms of decades, not months or years. When I evaluate a business, I ask, can this business still be thriving in 20 years? Can it survive multiple economic cycles? Can it maintain its competitive advantages for decades? This long-term thinking automatically makes me more patient, because if I'm thinking in decades, short-term fluctuations don't matter. Quarterly earnings don't matter. Stock price movements don't matter. Only the long-term trajectory of the business matters. Third, I deliberately make it difficult to trade. I don't check stock prices every day. I don't have a brokerage app on my phone. I don't read market commentary. Why? Because all of that creates psychological pressure to act. It makes you impatient. It makes you think you need to do something. By reducing my exposure to market noise, I make it easier to be patient. I'm not constantly bombarded with reasons to trade. I'm not seeing headlines about what's hot or what's crashing. I'm just focused on the fundamental quality of the businesses I own. Fourth, I remind myself of the tax cost of trading. This is a big one that most investors ignore. When you sell an investment for a gain, you owe taxes on that gain. If you held it less than a year, you owe short-term capital gains tax, which is the same as your ordinary income rate. Even if you held it longer, you owe long-term capital gains tax. Those taxes are real money that comes out of your compounding. If you can defer paying taxes for decades by holding instead of trading, that's money that continues to compound for you. Over long periods, the difference is enormous. Warren has a great example of this. He calculated that if Berkshire had to pay taxes on all its embedded gains, the company would be worth perhaps 40% less than it is. That's the value of patience and tax deferral. Fifth, and this is crucial, I accept that being patient means missing opportunities. There will always be some hot stock that doubles or triples while I'm sitting on my hands holding boring businesses. That's fine. I'm not trying to catch every move. I'm trying to compound steadily over decades. Missing opportunities doesn't bother me, because I know that chasing opportunities, being impatient and constantly looking for something better, is what destroys wealth. I'd rather miss some winners and compound consistently than chase every opportunity and disrupt my compounding. Let me give you a specific example from my own experience. In the 1970s, I owned a significant position in blue chip stamps. The stock went through long periods where nothing happened, just sat there. Didn't go up, didn't go down, just boring. During this time, there were dozens of other stocks that were going up much faster. My brain kept saying, why are you holding this boring thing? You could be making more money elsewhere. But I was patient. I understood the business. I knew it was generating cash. I knew it would work out over time, and it did. But it took years, and it required enormous patience to sit through those boring periods when nothing was happening. Most investors would have sold and moved on to something more exciting, and they would have missed the eventual payoff. That's what patience looks like in practice. It's not glamorous, it's not exciting, it's often boring, but it's how you build real wealth. Here's the bottom line on impatience. The biggest money is made by finding wonderful businesses, buying them at reasonable prices, and then doing nothing for decades. That's it. That's the whole game. But doing nothing is psychologically very difficult. Your brain wants action. The market is constantly tempting you with new opportunities. Other investors are making money on trades. You need to resist all of that. You need to accept that patience is more valuable than cleverness. You need to internalize that compound interest, given enough time, will make you wealthy, but only if you don't interrupt it with impatient trading. Be patient. Hold great businesses for decades. Don't check prices constantly. Don't trade unless you have a compelling reason. And remember, activity is not the same as progress. Sometimes the best thing you can do is nothing. Now, the fifth sin is one that people don't think of as a sin at all, but it's killed more investors than almost any other mistake. The fifth deadly sin is complexity, and this one is particularly dangerous for intelligent people because intelligence often leads them straight into this trap. Here's how complexity destroys investors. Smart people love complex problems. They enjoy demonstrating their intelligence by solving difficult puzzles. So when they encounter a simple investment opportunity, they often pass on it because it seems too obvious, too easy, too boring. Instead, they gravitate toward complex situations where they can show off their analytical skills. This is backwards. In investing, complexity is usually the enemy of returns. The best investments are usually simple businesses that are easy to understand. The more complex an investment is, the more things can go wrong, the more assumptions you need to make, the more opportunities for your analysis to be wrong. Let me give you a perfect example of this. When Warren and I first looked at See's Candies in 1972, it was an incredibly simple business. They made chocolate candy. They sold it in their own stores. They had a strong brand, especially around holidays. The economics were straightforward. Low capital requirements, high margins, predictable demand. There was nothing complex about it. No complicated derivatives, no intricate financial engineering, no sophisticated valuation models required. Just a simple business selling a simple product to consumers who loved it. And that simplicity was part of its appeal. We could understand every aspect of the business. We could see why customers would keep buying. We could predict the cash flows with reasonable confidence. We could identify the risks. Simple. Now compare that to something like long-term capital management strategies. They were using complex derivatives, complicated mathematical models, intricate hedging strategies across multiple markets. The strategies were so complex that even the geniuses running the fund probably didn't fully understand all the interactions and dependencies. When you have that level of complexity, you have fragility, you have hidden risks, you have assumptions buried in your models that may not hold, you have interconnections you don't fully understand. And when something goes wrong, and something always eventually goes wrong, complex systems fail catastrophically. Simple systems fail gracefully. Complex systems fail catastrophically. That's a fundamental principle of engineering, and it applies to investing as well. Now, why do intelligent investors gravitate toward complexity? Several reasons. First, as I mentioned, smart people like to demonstrate their intelligence. If you invest in simple, obvious things, you can't show how smart you are. But if you invest in complex derivatives or sophisticated arbitrage strategies or cutting-edge technology companies, you get to show off your intellectual capabilities. Second, complexity can be used to justify higher fees. If you're a money manager, you can't charge high fees for buying and holding simple businesses. But if you're running complex quantitative strategies or sophisticated hedge fund tactics, you can justify charging 2% management fees and 20% performance fees. Third, complexity creates the illusion of precision. When you build a complicated financial model with hundreds of assumptions and calculations, you get an output that looks very precise. This stock is worth $47.23 per share. That precision feels scientific. It feels rigorous, but it's false precision. because your model is only as good as your assumptions. And in complex models, you have hundreds of questionable assumptions. Fourth, complexity allows you to ignore what you don't understand. If an investment is simple, you have to admit when you don't understand something about it. But if an investment is complex, you can always say, well, it's complicated, and people will nod and assume you understand the parts they don't. Let me tell you what I do to avoid the complexity trap. I have a simple rule. If I can't explain an investment to a reasonably intelligent person in 5 minutes, I don't understand it well enough to invest in it. This rule forces me to stay simple. It forces me to really understand what I'm investing in. It prevents me from fooling myself into thinking I understand something just because I can build a complex model of it. I also avoid businesses with complicated business models. Some businesses are just inherently complex. They have multiple revenue streams, complex supply chains, intricate regulatory environments, lots of moving parts. These businesses are harder to analyze and more likely to surprise you with problems you didn't anticipate. I prefer businesses where the value creation is obvious. Make a product people want, sell it for more than it costs to make. Repeat. Simple. If the business model requires a 30-page explanation, I'm probably not going to invest. Another technique is to avoid investments that require me to be right about multiple things simultaneously. The more things that need to go right for an investment to work, the lower your probability of success, because probabilities multiply. If you need 3 things to go right and each has a 70% chance, your overall probability is only 34%. I look for investments where I only need to be right about 1 or 2 things. The business has a great brand. I just need the brand to persist. The business has low costs. I just need them to maintain their cost advantage. Simple, few dependencies. Warren has a great phrase for this. He talks about investing within your circle of competence. Your circle of competence is the set of businesses and industries you truly understand deeply. For Warren and me, that circle is actually pretty small. We understand insurance, we understand some consumer brands, we understand some financial services businesses, but we don't try to invest outside that circle. We don't pretend to understand biotechnology or semiconductors or complex derivatives just because they might offer higher returns. We stay within our circle where things are simple and understandable to us. This is humility, but it's also smart, because when you stay within your circle of competence, you can make much simpler, more reliable judgments. You're not guessing. You're not relying on complex models. You're using genuine understanding built up over decades. Let me give you a specific example of how complexity can destroy you. In 2008, many banks failed or needed bailouts because of their exposure to complex mortgage-backed securities and derivatives. These were products so complex that even the people who created them didn't fully understand them. The banks that survived the crisis were generally the ones with simple business models. Take Wells Fargo. Yes, they made mistakes, but their core business was simple. Take deposits, make loans, manage risk conservatively. When the crisis hit, they understood their exposures. They knew what they owned. They could manage through it. Contrast that with something like Lehman Brothers or Bear Stearns, which had enormous positions in complex structured products. When the crisis hit, they couldn't even figure out what their positions were worth. The complexity made the situation unmanageable, and they failed. Here's the bottom line on complexity. Simple investments aren't necessarily easy to find. You still need to do rigorous analysis. You still need to understand competitive dynamics, management quality, and valuation. But simplicity gives you transparency. It gives you the ability to actually understand what you own. It reduces the number of things that can go wrong. Complexity, on the other hand, is a trap. It makes you think you're being sophisticated when you're actually just creating more opportunities for failure. It allows you to fool yourself into thinking you understand something you don't. It multiplies the number of assumptions you need to get right. Avoid complexity. Seek simplicity. Invest in businesses you can explain simply. Stay within your circle of competence. Remember, you get paid for being right, not for being clever. Simple and right beats complex and wrong every single time. But there's a sixth sin that might be even more destructive than complexity, and it's one that most investors commit daily without even realizing it. The sixth deadly sin is ideology, and I need to be very clear about what I mean by this because people often misunderstand. I'm not talking about having values or principles. I'm talking about letting rigid ideological beliefs distort your perception of reality and cause you to make bad investment decisions. Here's how ideology destroys investors. When you have a strong ideological commitment to a particular view of how the world works, whether it's free market fundamentalism or socialist economics or libertarianism or whatever, you start filtering information through that ideology. You see evidence that confirms your ideology. You dismiss evidence that contradicts it. And you make investment decisions based on your ideology rather than reality. Let me give you a specific example. In the 1970s, many conservative investors were convinced that high inflation and government spending would inevitably lead to economic collapse. This wasn't just an economic prediction, it was an ideological conviction. America was abandoning free market principles. We were becoming socialist. The end was near. So these investors positioned their portfolios for collapse. They bought gold, they shorted stocks, they avoided productive businesses, and they missed one of the greatest bull markets in history. Why? Because their ideology prevented them from seeing reality as it actually was. Or take the opposite example. In the 1990s, many liberal-leaning investors were convinced that technology and the internet would create a new paradigm of unlimited growth and prosperity. Old economic rules didn't apply. Valuations didn't matter. This was a new era. The ideology of technological progress blinded them to obvious signs of a bubble. The common thread in both cases is that ideology replaced analysis. Instead of looking at actual businesses, actual cash flows, actual valuations, and actual competitive dynamics, these investors were looking at the world through an ideological lens that distorted everything. Now you might say, Charlie, don't you have beliefs about how the economy works? Of course I do, but here's the critical difference. My beliefs are tentative and subject to revision based on evidence. I'm not ideologically committed to them. If the evidence shows I'm wrong, I'll change my view. Ideologues can't do this. When evidence contradicts their ideology, they explain it away. They find reasons why the evidence doesn't count. They double down on their ideology, and they make increasingly bad investment decisions as a result. Let me tell you about a specific mechanism by which ideology destroys investment returns. Ideology causes what psychologists call confirmation bias on steroids. Normal confirmation bias is bad enough. We all tend to seek out information that confirms what we already believe. But ideological confirmation bias is much worse. When you're ideologically committed to a view, you don't just prefer confirming information. You actively reject disconfirming information. You attack the credibility of sources that disagree with you. You create elaborate explanations for why evidence that contradicts your ideology doesn't actually count. I saw this destroy a very intelligent investor I knew in the 1980s. He was ideologically committed to the idea that government debt would cause hyperinflation. This wasn't just a prediction, it was a moral conviction. Government spending was evil. Debt was evil. Inflation was the inevitable consequence. So he positioned his entire portfolio for hyperinflation, bought gold, shorted bonds, avoided stocks, and he held these positions for decades. Meanwhile, government debt grew, inflation stayed low, stocks went up dramatically, and he missed all of it. His ideology prevented him from seeing reality. What made this particularly tragic is that he was smart enough to understand the actual economic mechanisms. If he had looked at the evidence objectively, he would have seen that his predictions weren't coming true. But ideology prevented him from being objective. He kept waiting for the hyperinflation that never came. This is what ideology does. It locks your brain into a pattern and prevents you from updating based on new information. And in investing, the inability to update based on new information is fatal. So how do you avoid ideological thinking? This is difficult because everyone thinks their beliefs are rational and everyone else's are ideological. But here are some specific techniques I use. First, I actively seek out smart people who disagree with me, not to argue with them, but to understand their perspective. If someone intelligent sees the world differently than I do, there's probably something they're seeing that I'm missing. I want to know what that is. Second, I try to hold my beliefs tentatively. Instead of thinking this is definitely true, I think based on current evidence, this seems most likely to be true, but I could be wrong. That small mental shift makes a huge difference in your ability to update your views. Third, I pay attention to my emotional reactions to information. If I find myself getting angry or defensive when confronted with evidence that contradicts my views, that's a warning sign. It means I might be too emotionally invested in my beliefs. It means I might be sliding toward ideology. Fourth, I separate my investment decisions from my personal values. I can believe certain policies would be good for society while simultaneously recognizing that those policies might be bad for certain investments. My job as an investor is to see the world as it is, not as I wish it to be. Let me give you a personal example of this. I have strong views about corporate governance and business ethics. I believe companies should treat their employees well, should act responsibly toward the environment, should play by the rules. These are values I hold, but I don't let those values turn into ideology that distorts my investment decisions. If a company with mediocre ethics is still a good investment because it has a strong competitive position and reasonable valuation, I'm capable of recognizing that. I separate what should be from what is. Fifth, I test my beliefs against reality constantly. This is the most important defense against ideology. Reality doesn't care about your ideology. Markets don't care about your ideology. If your ideological beliefs lead to bad predictions, reality will punish you with losses. So I keep a written record of my predictions and I check them against outcomes. When I'm wrong, I analyze why. Was I wrong about facts? Was I wrong about causal relationships? Was ideology affecting my judgment? This feedback loop prevents me from drifting too far into ideological thinking. Here's a specific historical example that illustrates this. In the 1930s, many investors were ideologically opposed to Franklin Roosevelt's New Deal policies. They thought government intervention in the economy was wrong, would fail, and would lead to disaster. Now, you could hold that ideological position and still make good investment decisions if you accurately predicted market responses. But many of these investors let ideology distort their analysis. They predicted catastrophe that didn't occur. They stayed out of markets that recovered. Their ideology cost them money. Warren's father was one of these ideologues, very right-wing, very convinced that government intervention would destroy the economy. Warren observed this as a kid and consciously decided to avoid ideological thinking. He said ideology was dangerous. It prevented you from seeing reality clearly. That decision to avoid ideology and just focus on what actually works was probably one of the most important factors in Warren's success. He didn't care whether markets should work a certain way, according to some ideological framework. He just observed how they actually work and invested accordingly. Here's the bottom line on ideology. Have values, sure. Have principles, absolutely. But don't let those values and principles harden into ideology that prevents you from seeing reality. Don't let your beliefs about how the world should work prevent you from seeing how it actually does work. Be willing to change your mind when evidence shows you're wrong. Be willing to hold positions that conflict with your political or philosophical views if the investment case is sound. Be willing to admit you don't have all the answers. That flexibility, that lack of rigid ideology, is essential to good investing. Avoid ideology. Stay flexible. Update your views based on evidence. Remember that reality doesn't care about your beliefs. And remember that the most successful investors are pragmatists, not ideologues. Now we come to the seventh and final sin. And this might be the most subtle and most dangerous of all. The seventh deadly sin of investing is groupthink. And this is the sin that causes the most catastrophic losses because it operates at the level of entire markets rather than individual decisions. Here's how groupthink works. Humans are social animals. We evolved in small tribes where conforming to group behavior was often essential for survival. If your tribe thought something was dangerous, you thought it was dangerous too, because disagreeing with the tribe could get you killed. This instinct is still with us. We feel psychological pressure to agree with our peer group. We feel uncomfortable being the only one who disagrees. We worry about looking foolish if we're wrong and everyone else is right. So we conform. We go along with the crowd. We think what everyone else is thinking. In everyday life, this is mostly harmless. But in investing, it's catastrophic. Because markets are mechanisms for transferring money from the conformists to the contrarians. When everyone thinks the same way, you have bubbles and crashes. And the people who profit are the ones who had the courage to disagree with the crowd. Let me give you the most obvious example. The dot-com bubble of the late 1990s. By 1999, there was overwhelming consensus that internet stocks could only go up. Analysts said so, the media said so, your neighbors said so. Everyone was making money. The few skeptics were ridiculed as out-of-touch dinosaurs who didn't understand the new economy. That was groupthink in action, and it created the perfect environment for a catastrophic bubble. Because once everyone thinks the same way, there's no one left to buy. The only direction prices can go is down. And when they started going down, everyone tried to sell at once and the bubble collapsed. Warren and I didn't participate in that bubble, not because we're geniuses, but because we're not susceptible to groupthink. When everyone else thinks something is obviously true, our instinct is to question it more carefully, not to accept it more readily. This wasn't comfortable at the time. People thought we were fools. Our shareholders complained. The press mocked us. But we didn't care what other people thought. We cared whether the valuations made sense. They didn't. So we sat out the bubble, and we preserved our capital for when the crash came and opportunities became available. Now let me tell you about the psychological mechanisms that make groupthink so powerful. First, there's social proof. When we see everyone else doing something, our brains assume it must be correct. This is an automatic, unconscious process. You can't just turn it off by being aware of it. Second, there's authority bias. When authority figures, respected analysts, successful investors, Nobel Prize winners, all say the same thing, we tend to accept it without sufficient scrutiny. We defer to their expertise even when they might be wrong. Third, there's commitment and consistency bias. Once you publicly agreed with the consensus view, you have a strong psychological need to remain consistent with that position. Changing your mind feels like admitting you were wrong, which is psychologically painful. Fourth, there's what I call career risk. For professional investors, if you're managing other people's money and you disagree with the consensus, you take career risk. If you're right and everyone else is wrong, you're a hero. But if you're wrong and everyone else is right, you might lose your job. So many professional investors go along with the crowd even when they privately disagree. All of these mechanisms work together to create powerful pressure toward conformity. And most people, even intelligent, educated, successful people, can't resist this pressure. So how do you fight groupthink? This is difficult because it requires going against your social instincts. But here are specific techniques I use. First, I deliberately cultivate a contrarian mindset. When I see consensus forming around some view, my immediate reaction is skepticism. Not automatic disagreement, that would be just as bad, but skepticism, a willingness to question whether the consensus might be wrong. Second, I seek out dissenting opinions. When everyone seems to agree about something, I actively look for smart people who disagree. I want to understand their reasoning. I want to stress test the consensus view against the best counter-arguments. Third, I have a rule. Never invest in something just because everyone else is doing it. If my only reason for making an investment is everyone else thinks it's a good idea, that's not a reason, that's groupthink. Fourth, I pay attention to valuations. This is crucial. Groupthink typically drives prices far away from fundamental value, sometimes too high, sometimes too low. If I focus on valuation rather than on what everyone else is doing, I can avoid the groupthink trap. Let me give you a specific example of how this works. In 2000, at the peak of the tech bubble, there was overwhelming consensus that Amazon would fail. The stock had crashed from over $100 to about $15. Analysts were calling it Amazon.bomb. The conventional wisdom was that they were burning cash, had no profits, and would go bankrupt. But if you looked at the actual business fundamentals, the customer growth, the repeat purchase rates, the operational improvements, you could see that they were building something valuable. The groupthink was wrong. The consensus had overcorrected from Amazon can do no wrong to Amazon will definitely fail. A contrarian investor who ignored the groupthink and looked at actual fundamentals could have made 40 times their money over the next decade. But that required having the courage to disagree with everyone. I'll give you another example from the other direction. In 2006 to 2007, there was overwhelming consensus that housing prices could only go up. Everyone agreed. Real estate agents, mortgage brokers, Wall Street analysts, government officials. Housing always goes up in the long run. That was the groupthink. But if you looked at actual fundamentals, the historic ratios of prices to incomes and rents, the declining lending standards, the proliferation of subprime mortgages, you could see a bubble forming. The few people who said so were dismissed as pessimists who didn't understand real estate. The contrarians who bet against the bubble, and there were very few of them, made enormous returns. But they had to be willing to look foolish for several years while housing kept going up and everyone told them they were wrong. That's what fighting groupthink requires. It requires being comfortable looking foolish. It requires trusting your own analysis over the consensus. It requires being willing to be alone in your position. Now, I need to make an important distinction here. Fighting groupthink doesn't mean being a contrarian for the sake of being contrarian. It doesn't mean automatically disagreeing with whatever the crowd thinks. That's just groupthink in reverse. You're still letting the crowd determine your thinking, just in the opposite direction. Real independence of thought means evaluating each situation on its merits, regardless of what anyone else thinks. Sometimes the consensus is right, sometimes it's wrong. Your job is to figure out which, based on evidence and logic, not based on whether you're agreeing or disagreeing with the crowd. Here's another technique I use. I try to form my own opinion before I hear what anyone else thinks. If I'm analyzing an investment, I do my work first, reach my conclusions first, and only then do I listen to what others are saying. This prevents their views from anchoring my thinking. This is harder than it sounds, because we're constantly bombarded with other people's opinions, market commentary, analyst reports, news headlines, social media. If you're not careful, you absorb all those opinions, and they shape your thinking before you've done your own analysis. So I deliberately limit my exposure to market commentary and consensus views. I don't read analyst reports until after I've formed my own view. I don't watch financial television. I don't participate in investment discussions until I've done my own work. This helps me maintain independence of thought. Let me also tell you what doesn't work in fighting groupthink. You can't fight it by being aware of it. Knowledge that groupthink exists doesn't immunize you against it. The psychological pressures toward conformity are too strong. You need actual systems and processes that create independence of thought, not just awareness. You also can't fight groupthink by being smarter. Some of the worst groupthink I've seen has been among highly intelligent people, PhDs, Nobel Prize winners, successful CEOs. Intelligence doesn't protect you against social conformity. In fact, intelligent people are often better at rationalizing why the consensus must be correct. What does work is having the right temperament, combined with the right systems. The temperament of being comfortable disagreeing with others. The temperament of not caring what people think of you. The temperament of trusting your own judgment, even when it's unpopular. Combined with systems like doing your own analysis first, seeking out dissenting views, focusing on fundamentals rather than sentiment, maintaining a long-term perspective, and having the courage to act on your convictions even when they're unpopular. Here's the bottom line on groupthink. The biggest investment opportunities come from disagreeing with the crowd when the crowd is wrong. Bubbles form when everyone thinks the same bullish thoughts. Crashes create opportunities when everyone thinks the same bearish thoughts. The money flows from the conformists to the contrarians. But being a successful contrarian requires more than just disagreeing. It requires being right. And being right requires independent analysis, rigorous thinking, intellectual honesty, and the courage to stand alone. Avoid groupthink. Think independently. Form your own views based on evidence and logic, rather than on what everyone else thinks. Be comfortable being wrong. Be comfortable looking foolish. Be comfortable standing alone. That's how you avoid the seventh deadly sin. Now I want to show you something important about these 7 sins. They don't operate independently. They reinforce each other. They interact and combine to create what I call Lollapalooza effects. Situations where multiple factors operating in the same direction create outcomes far larger than the sum of the parts. Let me show you how this works with a specific example. The housing bubble of 2004 to 2007. That bubble wasn't caused by one sin. It was caused by all 7 sins working together. Envy. People saw their neighbors getting rich flipping houses. They felt left out. They wanted those gains too. Overconfidence. Everyone became convinced they understood real estate. Location, location, location. How hard could it be? Greed. People weren't content with normal returns. They used leverage, bought houses with 3% down, sometimes 0 down. They wanted to multiply their returns. Impatience. Instead of buying houses to live in long term, people were flipping them in months. They couldn't wait for compound appreciation. Complexity. The mortgage products became incredibly complex. Adjustable rates, negative amortization, interest-only payments. People didn't understand what they were buying. Ideology. Policymakers and investors were ideologically committed to the idea that homeownership was always good and markets always self-correct. Groupthink. Everyone believed housing prices could only go up. The few skeptics were dismissed as pessimists who didn't understand real estate. All 7 sins operating simultaneously, each one reinforcing the others, creating a massive bubble that eventually destroyed trillions of dollars of wealth. That's what I mean by Lollapalooza effects. When multiple psychological biases align in the same direction, you get outcomes that are far more extreme than any single bias would create. The housing bubble wasn't 7 times worse than if only one sin had been operating. It was exponentially worse. And here's what makes this particularly dangerous. When you're caught up in a Lollapalooza effect, it's almost impossible to see it from inside. Everything seems to make sense. Everyone agrees with you. All the evidence seems to point in the same direction. You feel certain you're right. That's when you're most at risk. That's when you need to step back and check. Am I committing multiple sins simultaneously? Is my judgment being affected by envy, overconfidence, greed, impatience, complexity, ideology, and groupthink all at once? If the answer is yes, you need to stop. You need to walk away from the investment no matter how good it seems. Because when all 7 sins are operating, you're almost certainly in a bubble, and bubbles always end badly. Now let me show you the opposite situation, how avoiding all 7 sins creates superior investment results. Take Berkshire Hathaway's investment in Coca-Cola in 1988. This was the opposite of the housing bubble in every way. No envy. Warren didn't invest because everyone else was. He invested because the business made sense. No overconfidence. Warren spent months analyzing the business. He questioned his assumptions. He looked for ways he could be wrong. No greed. Warren paid a fair price, not a bargain, but fair. He wasn't reaching for excessive returns. Patience. Warren was willing to hold forever. He wasn't looking for a quick flip. Simplicity. Coca-Cola is an incredibly simple business to understand. Make sugared water, sell it globally. Simple. No ideology. Warren didn't let his personal views about sugar or carbonated beverages affect his investment judgment. He just analyzed the business objectively. No groupthink. Warren formed his own opinion based on his own analysis. He didn't care what anyone else thought about the investment. The result? One of the most successful investments in Berkshire's history. Coca-Cola has made Berkshire tens of billions of dollars over 35 years. And it wasn't because of brilliance. It was because of discipline, because of avoiding the 7 sins. That's the pattern you want to follow. Every time you're considering an investment, check yourself against the 7 sins. Am I being envious, overconfident, greedy, impatient? Am I gravitating toward complexity? Is ideology affecting my judgment? Am I just following the crowd? If you can honestly answer no to all 7 questions, you're probably on solid ground. If you're committing even 1 or 2 of the sins, be very careful. And if you're committing multiple sins simultaneously, you're probably in trouble even if you don't realize it yet. Well, that's the 7 deadly sins of investing: envy, overconfidence, greed, impatience, complexity, ideology, and groupthink. These sins have destroyed more wealth than all the market crashes, recessions, and bear markets in history combined. Let me recap the key insights. Sin 1, envy, makes you compare yourself to others rather than to your own standards. Sin 2, overconfidence, makes you overestimate your abilities and underestimate risks. Sin 3, greed, makes you reach for returns you shouldn't reach for. Sin 4, impatience, makes you interrupt compound interest. Sin 5, complexity, makes you invest in things you don't really understand. Sin 6, ideology, makes you see the world through a distorted lens. Sin 7, groupthink, makes you follow the crowd into disasters. But here's the good news. You don't need to be perfect at avoiding all 7 sins all the time. You just need to be better at avoiding them than the average investor, because investing is a relative game. If you can avoid major mistakes that others consistently make, you'll do very well over time. And these aren't particularly difficult sins to avoid if you're systematic about it. You need self-awareness. You need discipline. You need systems and processes that protect you from your own psychology. But you don't need genius-level intelligence. You don't need special information. You just need to consistently avoid being stupid. That's what Warren and I have done for 60 years. We're not smarter than most investors. We're just better at avoiding stupidity. We're better at recognizing when we're about to commit one of the 7 sins. And we're better at stopping ourselves before we do. You can do this too. Create your own checklist based on these 7 sins. Before making any investment decision, work through the checklist. Ask yourself, am I being envious, overconfident, greedy, impatient? Am I attracted to complexity? Is ideology affecting me? Am I just following the crowd? If you're honest in your answers and you have the discipline to walk away when you're committing sins, you'll avoid the catastrophic mistakes that destroy most investors. And if you can avoid catastrophic mistakes while making reasonable investments, compound interest will make you wealthy over time. That's the whole game. It's not complicated. It's just hard to execute consistently, because these sins are rooted in human nature. But that's also why it works. If it were easy, everyone would do it, and there would be no advantage. I'm 99 years old. I've spent 6 decades studying how investors destroy themselves, and I can tell you with certainty, it's always the same 7 sins. Learn to recognize them. Learn to avoid them. Build systems that protect you from them, and you'll do just fine.